Economics for Everyone, Micro and Macro by Stanley Thuku Waithaka. The basic economic problem, which is also referred to as economic questions in economics. The basic economic problem is how to allocate the scarce resources to satisfy the unlimited wants of human beings. To do this, economists must answer 4 questions. These questions are: what, how, whom, and distribution. That is the question of what, the question of how, the question of whom, and the question of distribution. By answering these questions, economists will have dealt with the basic economic problem, i.e., the problem of allocating the scarce resources to satisfy the unlimited wants of human beings. These resources, remember, are the factors of production, which we need to produce what human beings want, that is, goods and services. Starting by looking at the question of what, economists are asking what should be produced in order to satisfy the unlimited wants with limited resources. So this is what the economists start. Yes, they start by dealing with this question of what should be produced in order to satisfy our unlimited wants with limited resources. The answer to this question is goods and services. People want goods and services such as food, clothing, and services such as education, etc. The next question economists must deal with is the question of how. And here, economists address this question by asking how should these goods and services be produced. And to deal with this question, to produce these goods and services, the factors of production are needed. In order to produce goods and services to satisfy our unlimited wants, we need the factors of production. These are the resources, and therefore must be used in the most efficient manner because they are scarce. We must maximize on their use, e.g., we should use these factors of production to the maximum. For example, we can use different techniques to maximize on what we have: more labor than capital, then we can use labor-intensive techniques of production, like in most less developed countries like Botswana, Kenya, Tanzania, Uganda, etc. But where we have more capital, then we should maximize on utilizing this capital by using capital-intensive methods of production. This is the case with countries that are highly developed like Japan, America, and most European countries. So we need to maximize on the factors of production, use them in the most efficient manner. The third question is a question of whom. And here we ask ourselves, who should get the goods and services that are produced? The question of who gets the goods and the goods and services that are produced is very controversial. In all cases, it is those who can afford or those who do receive from the government or donors who get the goods produced. Economists are of the view that everybody must at least have the basics for survival. And this is where you find some countries like Botswana providing the basics of survival to those people who can't afford them. They are normally referred to as destitutes in Botswana. They are given food, clothes for survival, the basics. Finally, the question of distribution. This question is not addressed by most authors, but it is a very important question, and this question deals with how should wealth be distributed. It is important to note that during the process of production, wealth is created. What do you mean by wealth? Wealth refers to accumulated assets. Assets are possessions that have value, such as cash, buildings, and other properties. So, during the process of production, wealth is created. Now, the people who get the wealth are the owners of the factors of production, i.e., the owners of land, labor, capital, and entrepreneurs. Anybody else will only get wealth from the government or donors. Economists are very much interested in how this wealth is distributed, because the economist's view is that at least wealth should be distributed fairly. The economist's view is that the gap between the rich and the poor people should be narrowed, and also the gap between the rich regions and poor regions should be narrowed. And therefore, this question must be addressed. How do we narrow this gap? Economists come up with solutions. Some of these solutions are through taxation. For example, a tax system such as pay as you earn, payee, which taxes people with high income higher tax than people with lower incomes. You are taxed according to the income. And by so doing, the gap between the rich is narrowed. Some people below certain levels of income are not taxed at all. This is just an example. There are other methods, but economists come up with solutions to deal with this. We've noted that the question of what to produce is the one that is looked at by economists. And we have said that goods and services need to be produced. Now, these goods and services are classified into various classes or groups, and these include consumer goods. These are goods that are used by individuals or households to satisfy their wants, e.g. food, clothing, drinks, furniture, motor cars, etc. They are normally produced for present consumption. The other type of goods are the capital goods. These are goods used to produce other goods. They are goods that are already produced and they are used in production of other goods. And these goods include machinery, factories, school buildings, roads, bridges, etc. Capital goods facilitate more production and satisfaction in future. At this point, it is important to note that capital goods in economics are not the same as capital in accounting. Economists look at capital as the goods that are used to produce other goods. Accountants, on the other hand, refer to capital as the owner's contribution to the business. So they are not the same. They are not the same. These goods are further put into different categories, and one category is non-durable consumer goods. Non-durable consumer goods are those goods that are used once only, such as food, drinks, petrol, etc. We use them once and that's it, they are finished. Consumer goods are further divided into semi-durable consumer goods. These are goods that can be used more than once and usually last for a limited period of time, e.g. clothing, shoes, motor car tires, etc. And the last category of consumer goods are the durable consumer goods. These are goods that normally last for a number of years, e.g. furniture, washing machines, motor cars, etc. The other classification of goods is the final and intermediate goods. Final goods are goods that are consumed by individuals, households, and farms. E.g., a loaf of bread is a final good. It is important to note that a good can appear in different classes. For example, bread is a final good and it is also a consumer good. These classifications are put for purpose of clarifying certain economic issues or explaining certain economic issues. We have intermediate goods. Intermediate goods are goods that are purchased to be used as inputs in producing other goods. The word intermediate means in between. These goods are then processed further before they are sold to the end users. E.g., flour used by bakers is an intermediate good. The bakers will use flour to make mandazi or chapati or magwinya. However, the same flour, if it's purchased by households, it will be referred to a final good. The difference between the two is that the flour that is used by a baker to make chapati, mandazi, magwinya, etc. Is for purpose of sale. The chapatis are prepared so that they can be sold. But the household who buys flour prepares chapati for final consumption, and therefore, from the point of view of the household, flour is a final good. But from the baker's point of view, flour is an intermediate good. It's very, very important to get this distinction. Yes. One, we are preparing the final good with an intention of resale. The other one, we are preparing the final good for consumption, and therefore it becomes a final good. We have another classification of goods, private goods and public goods. Private goods are those goods that are consumed by individuals or households. And to be able to understand this classification very well, these goods, we are talking about goods like motor cars, foods, clothing. Now, why we are calling them private is that these goods cannot be consumed by everybody. It is important to note that in case of these goods, consumption by others can be excluded. That's what we say in economics, that some people can be stopped from using such goods. Therefore, we call them private goods. For example, in case of somebody's house, you can say it's private property. Trespassers will be prosecuted, or somebody's land. Trespassers will not be allowed. You only allow certain people and stop others. It's private property. So the explanation there is that consumption by others can be excluded, and therefore they become private goods. The opposite of these are public goods. These are goods that can be used by the community or society at large. The difference between public goods and private goods is that consumption by individuals, where public goods are concerned, cannot be excluded. And examples of these are traffic lights, defense, weather forecasts, and others. Nobody can be stopped from using these goods. Nobody can be stopped from using these goods. Everybody is free to use a public road, for example. Yes, those are public goods. So consumption by individuals cannot be excluded. Pure public goods are also known as merit goods. These are goods that must be supplied collectively because they cannot be withheld from one consumer without withholding from all other consumers, e.g. defense, street lighting. If you withhold street lights from one consumer, all the other consumers using that street will also be missing the light. If you withdraw defense from one national defense, then it means the whole country, everybody in that country will not be defended. Then we can talk of quasi public goods. Quasi is Latin word meaning as if it is, or non-pure public goods. We've talked about pure public goods and non-pure public goods. These are goods such as education and health services that can be supplied privately. The state, however, provides them because it is felt that quality or quantity may be inadequate if left to the private sector only. Good examples are universities, where we have private universities and public universities. The government comes in to bridge the gap to ensure that there is enough quality and quantity for its citizens. So these kind of goods are called quasi or non-pure public goods. They are provided by both the private sector and the public. So they have some element of private, and some element of public. The other classification of goods is economic goods and free goods. Now, when you talk about economic goods, these are goods that are produced at a cost from scarce resources. These goods are scarce, and therefore they are called scarce goods. And most of the goods that we see around are scarce. And scarce goods have a price or opportunity cost. The scarcer a good is, the higher the price. Gold is scarce and therefore is very expensive. So economic goods are goods that have got a cost, and they are scarce goods, and the scarcity of these goods is measured by the price of the goods. The more scarce they are, the higher the price. The other goods are free goods. These are goods that are not scarce and therefore have no price. Most people will think that when a government gives free education to its citizens, that education is free. No, it's not free. It means this is something else. Free goods are goods that have got no price. Free education by the government is not free because the government is meeting the cost. The government is paying a price. Free goods do not involve a price. There is no price paid. An example of free good is air, sunshine, seawater at the coast, etc. It's also to note that fresh air in polluted cities can be scarce, as well as sunshine in cities with high-rise buildings. According to an American economist, there is no free lunch. It means that anything that has a price, even if you do not pay for it, is not a free good. If one is educated by the government without paying for it, this is not a free good because the government will have paid for it. And finally, we have homogeneous and heterogeneous goods. Homogeneous goods are those goods that are exactly the same. They are alike in all aspects. E.g., color, quality, size, etc. There are a few examples of homogeneous goods. For example, a gram of fine gold is an example. 1 gram of fine gold in one country will be exactly the same as a similar gram of fine gold from another country. E.g., a gram of fine gold from South Africa would be the same as a gram of fine gold from Russia. The other classification is the heterogeneous goods. Hetero means different. These are goods that are different in terms of quality, quantities, color, or brands. Most goods are homogeneous, e.g., a table and a chair. So the goods that we've mentioned above must be produced in order to satisfy our unlimited wants. Remember, we said that economists must deal with the question of what to produce. And these are the goods that must be produced in order to satisfy our unlimited wants. They will be explained later on as we move on, and we will see the need for this classification as we progress. Thank you for watching this video. Please remember to click on the like and the subscribe button below. The book is on special at Amazon.com for only $1.99 US. Feel free to give your comment and keep tuned for the next video.